You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That music means we are back once again. It is Thursday, time to talk some futures options. Yep, it is time for TWIFO. My name, of course, Mark Longo from the THEOptionsinsider.com, as well as from the network of how much all of you folks are mainlining this week. Hope you're having a good trading week out there. A lot to break down. Should be a fun one. Of course, if you like what you hear, this show, or anything else, throw a like, a star, a comment, a rating, and review. Could be on any platform. People rate us and review and comment on just about every platform under the sun out there. It all helps in aggregate new people continue to discover the content. And there are new people just about every day out there. Of course, if you want to go above and beyond, you want to join us, let's say tomorrow, for Options Oddities after Volatility Views or our Pro Q&As or all the other cool stuff we have, the giveaways, the early access to a lot of our other content, theoptionsinsider.com/pro is the place to go to learn more. As we learn who's joining us in the old CME Group hot seat today, I'm pleased to welcome back our old friend, Miss Carley Garner from DeCarley Trading. Carley, welcome back to This Week in Futures Options.
Thanks, Mark. Good to be here as always.
Yeah, it's good to just talk some futures options. Always fun as we keep on rolling. It is time for the Movers and Shakers Report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers Report.
All right, everybody, welcome to the Movers and Shakers Report, the portion of the show where we break down what is lighting it up to the light side and to the dark side over there at CME Group this week. If you went and looked at the full report, listeners, you'd see it's a pretty strong green week. I mean, we could probably do a bottom, maybe scrape together a bottom 10, but that's kind of pushing it. Our bottom 5 is about it. Everything else this week is green, so it's a week of optimism, post-Fed, heading into summertime. People apparently, all is right with the world if you looked at this chart out there, listeners. To the dark side we go first. Number 5, we have feeder cattle off 1.6%. Like I said, not a lot. Not a lot going on the dark side this week, listeners. So, again, kind of hard to cobble together much more than just really a bottom 5 this week, listener. But number 5, feeder cattle. Number 4, listeners, we're going out to FX. You know, it's a sleepy week when FX is making it on the list. A yen USD off 1.65%. Number 3, it's live cattle off 1.67%. I'm seeing a trend. Everything's off 1.6% this week. Number 2, it's RBOB off 2.18%. It was number 3 in the same direction last week, off nearly 6%, 5.82%. Nothing that dramatic this week because our number 1 dark side mover, listeners, is lean hogs off a whopping 2.3%. And that's it for our dark side this week. Not a lot to parse. Now to the light side we go, which is pretty much everything else this week, listeners. We had to cut it off at 5. That starts at utility sector for the S&P 500, up nearly 4.5% this week. So you could tell we're starting up 4.5%, and the dark side tops out at 2.3%. So you could tell big shift to the upside this week. Number 4, we're going to the ags. It's Chicago wheat, listeners, up 5.59%. Number 3, it's silver, the shiny stuff, up 5.75%. Number 2, back to the ags, and this time to the dairy. It is Class 3 milk, up 6.88%. That was number 1 in the same direction last week, up 19.51%. Bit of a banger week for Class 3 milk. And number 1 to the light side this week, a product Carley may be familiar with, nat gas, up 23.93%. So in a banger light side week, nat gas is taking the reins. Now let's move on to the world of volatility. What's moving in CVOL over there at CME this week, listeners? And you know, there's a lot of different ways you can crunch these numbers. If you folks head on over, just type CME and CVOL into your browser, you will be able to access the dashboard as well. And you could do exactly what we're doing here this week. Just go into the aggregates tab and then set the date for 1 week. And that will give you the CVOL pretty much movers and shakers for the week out there. So I'll break that down for you this week, listeners. And the trend is pretty much vol coming in. I think you could probably guess that from what I just broke down on the underlying side. Let's start in the FX aggregate vol. So again, these are the aggregate CVOLs for the entire complexes, listeners. FX, not known to be a bastion of volatility, but on the low end of it this week, 663 coming into the show. That has had a range on the week of 732 to the upside and now hanging out at the low end for the week of 663. So not much vol in FX to begin with, and even less this week. Behind it, we have the Treasury aggregate CVOL. This is Treasury price volatility. So there's 2 ways you can look at the Treasury's vols. Price vol, which I think makes more sense for people because they're used to seeing price volatility. Or you can talk yield vol. That's a little bit more obtuse. We'll get to that in a little bit. Price vol right now, aggregate for the Treasuries, is at a 5.92. That's off about 0.07 on the week. The low also at the week, the high was 651 about a week ago. So again, hanging out the lows for the week. Most of the things we're going to talk about are hanging out at the lows for the week, with the exception of one, listeners. Next, we have the metals CVOL. 1644 is where we're hanging out there. That's off 0.55, so a little over half a point on the week. Again, hanging out at its low level for the week. The high was 1765 earlier this week. The energy aggregate CVOL, a little bit higher, obviously, a little bit more vol in the energy complex, in particular in nat gas. So that one comes out at a 4162. That's off 0.69, so almost off 0.7 on the week. Again, hanging out at its low level for the week. The high was 4340 about a week ago. Now we go out to the commodities. They aggregate all the commodities over there at CME as well. The commodity aggregate CVOL, 28.75, off almost 0.75 of a point. Again, hanging out at exactly the low for the week. The high was 30.32 earlier this week. Let's go to the ags, the one product that is not at the bottom of its vol range for the week. The ag aggregate CVOL, 22.89. Remember, there's a lot of things going into that aggregate vol number for ags. You got wheat, you got corn, you've got dairy, all kinds of things with all kinds of vol levels, coming out to an aggregate vol level of 22.89, off 1.02 points on the week. Again, the low for the week was actually 21.94, so they have bounced off their low for the week. The high, 24.78. And then, if you want to get obtuse, listeners, we can get obtuse. Let's go to Treasury by yield volatility. That's at a 116.36. That's off 1.19 points on the week, and also hanging out at its low for the week. The high was 128.81, so quite a range of yield volatility this week. Again, we had the Fed in the rearview mirror last week, so not exactly surprising that we're seeing a little bit of volatility on the yield front. But Carley, I wanted to draw your attention to one other thing on the volatility front here as we're kicking off the show. CME putting out their In Focus newsletters they do every week, highlighting different trends on their products. They drew a particular focus on CVOL this week. I thought it was interesting for our listeners in particular because they went back and because vol is, as you mentioned, kind of coming in across the board, they graphed the 12-month average of the CVOL for every product and then compared it to where they're trading right now. And what they found is you could pretty much guess, listeners, by the numbers I just told you, pretty much every product is trading below their 12-month average CVOL, except for two, Carley. Let's play a fun game. Do you want to guess which two they are?
Sure. I'd probably say metals and ags.
That's why we have you on the show, because that is exactly correct. You're right. Metals and ags are the only two. Ags, obviously a very seasonal product and not much above their 12-month average, actually. Metals, obviously, quite a bit more above their 12-month average, but also off their highs. Their highs came about a few weeks ago. They're about, I'd say, halfway to that level now, but still obviously above their 12-month average. So again, in aggregate, Carley, we're seeing a lot of vol coming off. This is obviously not surprising information for you. You've been obviously trading these products all year long, but what are your thoughts on the fact that so far this year, this has been the year where vol has gone to die, Carley?
Right. And, we are kind of expecting this. We've had 3 years of nonstop chaos, multiple black swan events to the point where we almost have to redefine black swan because it's happening way more than it should. So it's been really, really wild. And I think we're probably in store for multiple years of lower volatility. At least I hope so. And I think historically, that's kind of what we've seen. We generally get really big flares of volatility and then it calms down sometimes for 5, 6, 7 years at a time. So I'm expecting things to continue to taper. With that said, what we're seeing just this week in particular has been pretty interesting with the grain specifically, because I think what happened is we just came into the month, or let's just say the last couple of weeks, with a really big net short position on the speculator side. And I think we're getting more of a short squeeze than anything. We're going into weather markets. So it's very seasonal to see volatility this time of year. But the reality is volatility in grains during this time of year is generally temporary. So be really careful. It could die pretty quickly.
All right, listeners, interesting stuff. You can check all that out for yourselves. Again, just type CME and CVOL into your browser. As we keep on rolling, it is time to kick off the show proper. And because Carley's here, we have to start in energy.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, listeners, to the topsy-turvy world of energy we go this week. Go into that cmegroup.com/TWIFO page. Go into that drop down. Go down about 3 slots in the asset class list to energy. And then, because it is leading our movers and shakers this week by a country mile, we're going to kick things off in nat gas. Coming in to start the show, looking a little bit juicier again, back north of that 2 handle at about a 229 this week, up about 15 cents or about 7% again just this week. If you go back to the end of our show last week, we're up about 23, almost 24%. So a banger week, banger resurgence here for nat gas. Carley, I know you watch nat gas keenly out there. Kind of an interesting time for a resurgence in energy. Obviously, we have turmoil overseas, but also, heading into the summer season, not usually a banger period for nat gas, Carley. Intriguing stuff. What's lighting up your tape in nat gas this week?
It is. Well, we basically saw natural gas trade sideways and near multi-year lows for several weeks, even maybe 2 or 3 months. And we finally broke out through the downtrend. So we're getting obviously some buying coming in. It's a little deceiving because we see it on the heat map that natural gas is up 20-something% on the week. And it is. But the reality is we started from such a low point that number looks a lot more exciting than it is. So just keep things in perspective. That said, I think we have finally broken the downtrend. Now, natural gas this time of year, as you mentioned, seasonally, it's not generally the time we get really, really big runs. So I would probably expect some back and filling, and you may even expect to see a retest of the downtrend line. And believe it or not, that would put us like on the June contract, that'd be back closer to $2. So we're talking, there's some room for a 25-30 cent pullback before we resume the uptrend, assuming we do, which I believe we've seen a low, and I think we will.
Yeah, you're right. It's easy to get a 20+% move and you're hanging out at around a $2 underlying. It certainly sounds good for the show, though. But Carley, I know you're not talking to us. You're slinging all sorts of funky nat gas ladders and all sorts of things. So what do you have up your sleeve? What is your nat gas, let's say, trade of the month or the week out there right now?
Well, so we had advised our clients to put on risk reversals. We were using the September options, so we had plenty of room for error and plenty of time. We put it on weeks ago, and it was basically the idea was we were selling $2 puts in September and then using the proceeds to buy $3 calls, and the markets moved in our favor. So now we're advising people to basically buy back that put, or at least have orders working to buy back that put, because that's where most of the risk is. And then we're hoping we get a little bit more upside here to pump those calls up. But again, I've said it on the show many times. This isn't the natural gas of a couple of years ago. This is a whole different marketplace. And if we can get somewhere in the high twos, I think that'd be kind of a realistic target. We're not looking for $5, $6, $7, some of the crazy stuff we've been seeing. This is a much quieter market.
Always nice when you put on those bullish risk reversals and the underlying pops. How nice. That's the way it's supposed to be, right?
Ideally, yes.
Well, you mentioned it's a very different market, and you're right. Just looking at some of these volume numbers, the nat gas continues to light it up, pun intended, out there. 688,000 contracts right now, listeners. So closing in on 700,000 contracts. We used to expect a busy week was 450 in nat gas. Now we're routinely well beyond that. So you're right. We definitely have shifted gears to a new vol and indeed volume regime out here in nat gas. So fascinating to watch the product evolve. That said, everybody loved the June contract this week going away in 19 days. 48% of the paper going up out there. So I guess we'll hang our hats there, listeners. Right now, the vol in the June contract, almost exactly a 50.15, off about 2.25 points. So obviously, as we said earlier in the show, vol is dying across the board. Even in nat gas, we've seen it in the mid 60s recently. Obviously, it's gone much higher than that, into the triple digits. Roughly half of that right now at about a 50. So kind of a quiet period. Again, it is the start of summer, not usually an explosive, again, pun intended, time for nat gas out there. So intriguing stuff. 50 vol out there. I guess you can say it's merited given what we're seeing out there. In terms of skew, not a lot going on skew-wise right now. It was pretty flat last week, and it's pretty flat again this week. So not a lot of bias we could see in any direction. Of course, if we go a little bit farther out, that's when some of that seasonality starts to kick in, especially if you get into the beginning of next year. You get into January, February of 2025. We're starting to see about a 7.5% discount to the puts there and 11.5% bid to the calls. So again, folks looking for, it's winter. Nat gas should be hot. Again, pun intended then. So the skew looking like it's expecting that again. By the way, that future out there in February of next year trading at about a 3.5. So quite a bit north of where we're trading right now in the June future. And speaking of what's trading right now, what was lighting it up out there this week, listeners? The big dog in nat gas in a pretty active week. It was the two puts expiring in June, going up 56, almost 57,000 times this week. Interesting because the OI is about 57,000. So a lot of opening paper this week on the two puts in June. 22,000, almost 23,000 on Monday alone. So a big day on Monday. Big day today as well. Nearly 18,000. 12,000 on Wednesday, and about 3,600 on Tuesday. So Carley, folks, opening for size on the two puts here in June. I know you said you were selling some puts earlier on that level. Is this all your volume? Is that you accounting for 57,000 contracts?
I wish. No. I'm more of a mode. I think it's too late to be a put seller here, and I'm not sure I'd be a put buyer just because 230 nat gas is pretty cheap. But to each their own, and maybe they've got the right idea. I do think we might pull back a little, so maybe they're in the right spot. But I'd rather be long calls than puts. That's for sure.
Yeah, well, somebody likes the puts this week, Carley. 2 puts going up 56,000 times. Right behind it, number 2, we have the 1 3/4 puts, also in June, going up 46,000 times. Now, there's some closing paper, so it looks like we had some rolls going on because the big day on the 1 3/4 puts. Also on Monday, listeners, 21,000 there versus about 22,000 of the 2s. Closing on the 1 3/4, opening on the 2s. So clearly, we had some vertical, indeed some rolling action. Maybe taking a chance to roll up your hedge to a little bit tighter or get a little bit closer to the fire if you're selling puts out there. Either way, it looks like a lot of roll action on Monday. A 7,700 on Wednesday, closing there as well. Nearly 16,000 today. There's still 62,000 open on this strike as of today. So if they're looking to close, they have a lot more they could potentially do. A total, like we said, of 46,000. Because that makes some sense, rolling up the 1 3/4 puts to the 2s. And then number 3, we have the 2.5 calls. So Carley was talking about the 3s. How about we split the difference and go 2 halves? 38,000 of those trading this week, also in June. Again, Monday, the banger day on Monday for nat gas. 17,000 of them going up, pretty much opening on Monday. 10,000 today against an OI of 27,000. So a lot going up on this strike. 8,000 yesterday, about 2,500 on Tuesday. So folks were opening on the 2 halves all week long, and it looks like opening on the 2 puts as well. So maybe you like that strangle, listeners. 2.5 in June. Pretty tight, but hey, it's interesting stuff. Or maybe you like that risk reversal, the way Carley was saying it earlier. And then behind it, we have the 2 1/4 puts. So 2.5 puts, maybe a little bit too far out there for you. 2 1/4 puts doing 36,000 contracts this week. The big day again Monday. So it looks like we have rolling action again there. 16,500, the 2/4 puts going up, mostly closing, versus about 17,000 of the 2.5 puts. So somebody, so these are the calls. I keep saying puts. These are the calls. So 2 1/4 calls, folks rolling those up to the 2 halves about 17,000 times on Monday. It looks like somebody also rolling the 1 3/4 puts up to the 2 puts on Monday as well. So Monday, a big rolling day, which probably accounts for a lot of our volume. And then the rest of the week, 8,500 on Tuesday, 6,000 today, about 5,000 yesterday against an OI of 23,000 on the 2 quarters. So intriguing stuff. Well, let's scroll a little bit farther out to see if we see any other paper. You know, something must have traded aside from June. Let's go see if we can find it. You know what, Carley? It seems like this week it's all about the 2 puts. The 2 puts in July going up 22,000 times. The 2 puts in September going up about 15,000 times. So apparently, Carley, you were on the money. You and everybody else were trading the 2 puts across the board in nat gas this week, Carley.
Guess so. I mean, I wouldn't be opposed to using buying 2 puts as, like, if you're going long futures and using that as a hedge and a backstop. That kind of makes sense to me. But buying them outright, I'm not sure.
Well, we're hanging out in energy. Any other energy products lighting up your tape this week, or do you perhaps want to segue on to another complex?
We're getting a lot of inquiries on crude oil, so if you're up for it, we can chat crude.
I don't know why anyone would care about crude oil right now. I mean, it's only just a borderline war in the Middle East. Why would anybody care about crude oil? So listeners, go in that drop down, pop out of nat gas, go up 2 slots to crude oil. We're going to kick on our old friend, a WTI out there, listeners. And again, was it a banger week for WTI? I suppose we'll find out. As my products are loading here, Carley, obviously you said a lot of clients are reaching out to you in WTI. What is lighting up your tape out there this week?
Absolutely. So obviously there's a lot of fundamental news that people are hearing and talking about. And so it creates some interest. And so we're getting a lot of inquiries on crude oil. And we basically, we're advising people not to chase the rally after war broke out in late March and wait for a pullback. And so we've helped them put on some option strategies to try to take care of, play the upside while giving it plenty of room for error. Using the August options is what we've been doing. Basically bull call spreads with naked legs. Haven't worked out perfectly yet because crude oil's been in a liquidation mode, but I think we're getting pretty close to support, 200-day moving average, some trend lines coming in. So we should start seeing prices move higher from here, I believe, in my opinion.
So you were liking some call spreads in WTI. Any particular months or strikes?
Yeah, so what we were advising, and this is a few weeks ago when oil was in the prior to the meltdown that we saw starting last week, oil had been holding a pretty steep trend line. And so we were advising our clients when crude pulled back to like $80 to start putting some stuff up on the upside. We were using August options, buying 85 calls, selling 90 calls, and then selling 70 puts. It's a free trade. The market broke support and sold off. So we were able to buy our call back, our 90 call at a profit. Now we're just hanging on to basically risk reversals where short August 70 puts and long August 85 calls, and feeling okay about it as long as we hold the high 70s. That we should be good, and that should recover for us. But timing wasn't perfect, that's for sure. But that's how things work out sometimes.
It is indeed. Let's see how things are working out there in WTI this week. Hanging out at about a 79.39, and that front future, listeners, up about 1.25 points, or about 1.64% on the week. Obviously, it's a banger week to the upside, so it takes a lot of upside movement to make it into our movers and shakers list this week. So WTI not quite clearing that bar. Did it clear on the volume front? Kind of. I would say it's an active week. It's more active than we would expect. It used to be around 450. Now it's up to 488, but not quite the explosive territory. Again, pun intended, like we've seen nat gas really taking that next leap from a volume perspective. Crude oil, at least not following suit, at least not this week. But what paper we saw out there, 41% going up in the June contract that has about 7 days to go. So we're going to hang out there, listeners. Very near dated paper. We don't usually hang out that close, but hey, you have to go where the paper takes you, listeners. And so vol there about 22.70, off about 2.5 points on the week. Again, 7 days to go. You could argue whether it's vol or gamma, but either way, that's what it is right now. If you go a little bit farther out, looks like 22.75 or so is about the level. If we go out about 20 days, we're still hanging out at about the same vol level. If we go a little bit farther out, we go out about 100 days. September vol is at about a 25, so a little bit higher, but not markedly different out there. Skew-wise, last week the puts were bid, 4.2% bid. This week, catching a little bit of a fire, 8.3% bid, so pretty much doubling out there in terms of the premium for the puts. So folks maybe looking for a little bit of downside over the next week. Calls last week, 1.3% cheap. This week, 6% cheap, so looks like our weekly options here are pretty firmly biased to the downside this week. That also makes sense when we see that the number one most active contract out here in WTI this week was the June 75 put, Carley, with about 18,000 going up. Pretty steadily active all week long. 6,000 and change on Monday, mostly opening. 6,000 and change again on Tuesday, again, mostly opening. About 4,300 on Wednesday, slightly closing. About 1,300 today, against an OI of 20,000. So looking at this skew, I'd have to wager a lot of folks were buying some puts out here this week. You like those, Carley? About 7 days to go, 75 puts. Does that float your boat?
That's not something that I would do, but I mean, I can kind of see the logic. Like basically, if you look at crude oil over the last 20 years, 75 is right at the equilibrium price, and those tend to be magnets. So I can see why they might think that. It's a cheap and easy way to play. I think the market a few weeks ago just got caught on the wrong foot, and like I said, we're in liquidation mode. I think it pauses quite a bit short of the 75 mark, but if it doesn't, maybe they're in the right place at the right time. We'll have to see. Time will tell.
Yeah, 7 days, not much time to get there. So they need this thing to kind of kick it into high gear to the downside. But
I will say this. I do hope they're wrong, because I'll be in trouble if they're right.
You're got the 80s, so you need to go the other way. Speaking of which, you're number 2 on the list this week, Carley, with the June 80s. Actually, you weren't June. You were a little bit farther out. But some folks are playing in the 7 day to go 80 calls this week as well, with nearly 15,000 of those, 14,500. The big day for those was Wednesday, 5,000 pretty much exactly, mostly opening, followed by about 3,300 each Monday and Tuesday. Weirdly enough, closing on Monday and opening on Tuesday, the exact same volume. So somebody just doing a 1 day trade there. Either way, interesting. And about 3,000 today against an OI of about 14,000 and change. So what do you like better, listeners? 7 days to go. Would you be a buyer of the 80 calls or perhaps the 75 puts? Would you sell them both, really tight strangle, and hope WTI just sits here for the next week? What's your preferred play out there? Then we kind of drop off volume-wise after that, listeners. It's about 77 puts. So interesting strike there, doing about 8,300 contracts to number 3. The big day for those was Wednesday, 3,000 there, 2,100 on Monday, and about 1,500 each Tuesday and today against an OI of about 9,000. Let's scroll a little bit farther out. You can usually find some interesting prints a little bit farther out. And you know what? That is the case. Looks like this is the week of the 75 puts, Carley. If we go all the way out this time to August. So we're going out about 69 days, Carley. The 75 puts also lighting it up out there to the tune of 12,620. So those would actually be kind of in the number 2 to 3 slot out there this week. So a kind of interesting 75 puts. The big day for those in August was Tuesday, 5,700 there, about 3,400 each Monday and Wednesday, and a big goose egg today against an OI of 4,600. So I don't know, Carley, I'm guessing if you had to buy a put, you probably would like the August 75s a little bit better than the 7-day to go kind.
Yeah, that's more my style. I mean, I think it's interesting though, like nothing changes sentiment like price. When crude oil's going up, like 2 weeks ago, everybody wanted to buy calls. Now it's going down. Everyone wants to buy puts. But what's interesting is nobody ever wants to buy calls when oil's going down and vice versa. And that's probably the better play on average. But, to each their own. Everybody has their own strategy.
Clearly. And then they also were lighting up the 81 calls also in August this week to the tune of about 11,700. So August getting some play out here. By the way, if you're wondering what the skew is shaping up like in August, futures at a 78.5. The vol's at a 24.43. And the skew last week, the puts 5.5% bid. This week, 7.1% bid. And the calls 2.3% cheap. Last week, this week, 3.5% cheap out there. And again, the 81 calls in August going up nearly 12,000 times this week. The big day was Tuesday, 4,400 mostly closing there, 3,000 on Wednesday. Looks like folks were bailing on these most of the week. The OI that's left is 2,100 going up today, or 2019, I should say, going up today against an OI of 2,043. So maybe folks are getting the heck out of Dodge and bailing on these 81 calls, which would also make some sense from a skew perspective. All right, Carley, we did a little sojourn through energy, but it sounds like metals, silver is certainly lighting it up this week to the light side, and from a vol perspective as well. What do you say we take a stop in the metals next?
Sounds good.
All right, listeners, to the shiny stuff we go.
Werewolves beware. It's time to explore the options activity in silver, gold, and other shiny things. It's time to talk metals.
All right, listeners, welcome to the metals. Go into that drop down, go into that asset class list, go all the way down to pretty much the bottom, which is metals. And we're going to hang out in the precious. And Carley, silver has been lighting up our list a lot over the last few weeks for obvious reasons. In fact, we even just talked about it an hour ago on the Option Block show, just talking about all kinds of options paper going up in the ETFs like SLV. So silver, a very hot product right now. I'm curious for your clients out there. Are they really into silver, or are they going to the old standby of gold?
Well, I mean, we've been mostly dealing with gold, probably because the option market's a little easier to deal with in the gold market as opposed to silver. We do have some futures traders in silver, but they're not enjoying themselves. I mean, it's been really, really choppy. If you look at a weekly chart, it looks pretty clean, but if you narrow down to a daily chart, it's been really, really ugly. So anybody placing stop loss orders instead of using long puts for protection purposes on their long futures are probably having a really rough time. We talk about ladders a lot on this show, and everyone questions that strategy, and it's a strategy that doesn't work, or doesn't make sense, I should say, most of the time, but there are rare occasions that it does. And we actually had a pretty good opportunity in gold to put on a ladder a few weeks ago when gold was really ramping up, and it's worked out thus far very, very well. So ladders can work when the volatility explodes, because you can get a lot of premium up above the market. And in this case, it actually, as gold pulled back, all the premium has come out of the short options. So it's allowed us to finance our trade without really getting into having too much stress. So when you see metals explode like that, not always, but if there's really just something out of the ordinary explosion, that's the time to put ladders on. most other circumstances is not the time to use ladders.
There you go. Defending ladders again, Carley. You're going to keep beating that ladder drum.
It can work.
Let me hit really quickly then on some of the papers. We got some paper here in silver. Then we'll get to gold. Nearly 60,000 contracts on the tape for silver. So not quite as explosive as we have seen in recent weeks, but a decent volume week. Weirdly enough, we have a bit of a tie for number one in terms of most active between the 24 puts in July and then my favorites, the 50 calls in December, listeners. Yes, the 5 O's. If you're wondering, the future out there is at about a 29.11. I don't know, Carley, are you big on the December 50 calls in silver this year?
I am not, and I'm actually bullish. I think silver probably sees the high 30s, but I'm not in the camp of $50. That said, if you're holding a December option, you're not going to get a lot of time value erosion, and so we don't have to get anywhere near 50 for that option to gain in value. If we get into the high 30s, you'll probably be in a pretty good spot. But I would say don't get greedy with it. If you've got a nice profit, make sure you hedge it, sell options against it, or get out or do something, because we're probably not going to be 50 or higher in December.
That is quite the long road there. It looks like they went up 3,000 times this week. Almost all of that on Wednesday, 2,800. It shows slightly biased towards closing here, but the OI coming into today is exactly 2,800. So it seems like they were opening a position on Wednesday. Either way, 2,800 of the 50s, 5 O's, listeners. That's my TWIFO trade of the week. I just like that one. It brings a smile to my face. As Carley's right, you don't need to get that close to 50 for having these to make money. Very much analogous to the junk VIX calls or S&P puts that we talk about a lot on some of our other shows. But still, it certainly is an eyebrow-raising a strike. Let's go out to the more active of the precious metals out here. Of course, the big dog, which is gold, listeners. Go into that precious drop-down. Pop out of silver, go up one slot to gold. Trading right now, 23.44, so well north of that very important 2,000 level out there in gold. Has been for some time. A decent week, if not the most explosive week out here from a volume perspective. 185,000 contracts on the tape. Again, you're talking about 3x silver, but again, not the most active week we've ever seen in gold history. Carley, you talked about having some gold ladders out there. Anything else lighting up your tape in the shiny stuff this week?
Well, what's interesting is, as we know, if you do a ladder, you're buying one call and selling two calls. So it leaves you open to upside risk. And us being bullish gold, we were a little more nervous about our upside risk than anything else. So it's nice to get a ladder on because ladders don't have any downside risk, but we were still concerned about that extra call. So what we did when gold pulled back is we actually put a bull call spread with a naked short put on top of it, so that we shift all of our risk higher if gold does go up. So we're getting a little bit complicated here, but the reality is the volatility has been really, really big. And so it gives option traders a lot of opportunity to sell premium around any long options they want to buy and let the market finance their trade. This is not for everybody. It takes a good amount of margin to do it. And also, as an FYI, we recommend our clients have quite a bit of margin excess, because when you're doing these types of strategies with naked legs and you have unlimited risk, the worst thing that can happen is to be forced out of something prematurely because you run out of margin. So we generally advise people to try to trade within 25 or 30% of their required margin requirement and leave 60-70% of their account as a rainy day fund, because that day will come where you need that extra cushion to ride things out and let the strategies do what they need to do.
So you're not using max capital on every trade here, Carley.
No, you can, but and that might work in the short run. I see people that get really excited. That might work for several months or maybe even a year or two, but it's going to be one day that you learn all those lessons right away that it's not going to work in the long run.
Like we say about just naked selling puts, it works until it doesn't, and you got to have the plan for when that doesn't work. Same thing if you're going max capital on every trade, especially on the futures side. Listen, that gets dicey pretty quickly. It
does.
Carley, when we talk about gold, we always can usually rely on some long-term upside call trading. And we got a little bit of that this week. But my favorites so far, again, 185,000 contracts on the tape this week, listeners. 34% of that going up in the June contract. It has about 19 days to go. So we're going to hang out there. That is the most active month. And Carley, what would you say if I told you it was the June 3,000 put that was leading our tape this week with 8,022 contracts? You don't see a lot of that. You don't see a lot of the deep in the money puts going up in the metals. You see the calls, meaty puts. I'm hard pressed. Think the last time I've seen this, Carley. What about you?
Yep. I don't know exactly what they're doing unless, I'm not quite sure what they're trying to do there. That seems like a lot of risk for, I don't know. I think there's better ways to play that.
Yeah, I mean, you're probably getting like effectively a synthetic short or underlying position at that point. But yeah, it's an interesting way to do it. That future's at 23.44.
Yeah, it takes a lot of capital to do a strategy like that. Like they must have a really big account, and honestly, their broker is being very lenient, or maybe their broker's charging them interest, because that's a lot of capital right there.
Yeah, I guess for some reason they didn't want to go short the future, so this way, at least it is risk limited from that perspective. At least in terms of volume, they traded pretty much all week long. They traded 4,200 times on Monday, Carley, mostly closing there, and then another 3,700 on Wednesday. 120 on Tuesday, a goose egg today. So there wasn't just a one-day trade. They were trading these most of the week. That's why we do the show, Carley. Even I've been doing it for a long time. It can still surprise me.
Yeah, I'm scratching my head. I have to do some research on that.
650 odd handle in the money puts. I like it. All right, that's my new metals go-to strategy. Deep in the money puts. Why not?
Right, why not?
Well, let's look for some more traditional paper, listen, and that can be found as well. Also, in that same cycle in June, we have the 2,400 calls, which again is a near out of the money call, almost 60 handles out of the money, going up 6,100 times this week. So that makes a little more sense. That's more of what we're used to. Again, 6,100 times, 2,100 today. That's the most busy day. Then 1,100 yesterday, 1,700 on Tuesday, and 1,100 again on Monday. So opening on Monday, closing the rest of the week. So maybe some folks are bailing on these calls, which makes some sense as you're getting closer to the strike. Maybe they've had them on for a while and they're deciding to get the heck out of Dodge and take some of their profits, or they're overwriting it and they're getting a little spooked. Either way, 6,100 of those going up this week. If we scroll a little bit farther down, we can also find, including the 2,500 calls in August, going up about 8,800 times this week. So those technically would be the number one most active contract. They outpaced the 3,000 puts by a little bit. But obviously, the 3,000 put, far more, shall we say, intriguing. The 2,500 calls in August, again, going up nearly 9,000 times this week. 2,800 times yesterday, 2,200 times today against an OI of 4,200. 2,200 times on Tuesday, 1,500 times on Monday. Opening earlier in the week, it looks like closing the latter portion of the week. So again, that future out there is at about a 23.66, so a little bit higher. So it makes some sense. I don't know if you want to take off all your 2,500s yet, but looks like some folks were willing to do that earlier this week. Let's just scroll around here a little bit, see if we find any other interesting and or aberrant paper, because there always is a funky condor or something. Maybe this week it's those in the money puts. Maybe those are the funky out of the money trade, or in this case in the money trade of the week out here. Interesting. Yeah, we got the 2,000s going up in September about 2,300 times. Those are obviously pretty meaty as well. Almost 400 handles in the money there. Not quite to the level of the puts, but intriguing. They went up 1,930 times on Tuesday and 400 times on Wednesday, opening on both days. Interesting. So meaty calls a little bit farther out and very meaty puts. Again, it's a meaty week here in the metals this week. Listen, all right, we're coming up against it, Carley. You probably have time for one more complex. So it'll be dealer's choice, whatever you want. What's floating your boat?
Let's look at grains.
Grains. All right, to the world of the ags we go, listeners.
It's time to get our hands dirty exploring the latest options, trades, and trends in corn, wheat, soybeans, and more. It's time to talk ags.
All right, to the ags we go, listeners. Pretty easy to find right at the top of our asset class list. It's an alpha order list after all. Agriculture, then grains and oil seeds, then Carley, it's dealer's choice. Where do you want to go? You like wheat this week? You like corn? You like the beans? What's catching your eye?
Wheat's been a big mover.
All right, to Chicago wheat we go, listeners. Go down 2 slots there to SRW wheat. All those Kansas City folks, don't get offended. Chicago wheat just trades more. 170,000 contracts on the tape this week. 637 and a quarter is where that front future is hanging out, up nearly 15 handles, or 2 1/3%. So a pretty active week, just obviously not enough to break into our top 5 this week. You needed to be north of 4.5% to make that happen. All right, Carley, what's catching your eye out there in Chicago wheat this week?
Well, we've had a pretty big accumulation of short positions across the grain complex. Wheat was including wheat. And so I think what we saw a few weeks ago was a really big short covering rally. But I talked to a lot of farmers and ranchers and hedgers, and what I'm hearing is that a lot of people have been hanging on to their grain, hoping for higher prices. So in other words, cash market people are short, and the future side of things, all the longs were washed out. So all of the Ukraine chaos worked its way through the system, left everybody short, and I think that we're just squeezing those out. And I think we've got some upside in the wheat market, maybe 665, maybe 680, somewhere in there, but this reminds me a lot of the 2014 markets, where the grains came out of a trough, had a nice summer, spring rally, and then rolled over and basically made new lows for the next couple of years. So if you have downside risk, if you're a rancher or farmer, make sure you do something about these prices, because they're probably temporary. Even if we go up a little further, they're probably temporary. So have some protection on.
Wise words. Let's see how wise the folks are out here in the wheat this week. Again, 170,000 contracts, over half of that, 52% going up in the July contract. Has about 43 days to go, so we'll hang our hat out there. The vol in wheat, actually pretty frothy, 37 1/3, up nearly 2 points. Kind of reflects what we were just talking about. Ag's one of the few complexes to buck the downside trend across the board. And vol, again, there's a seasonal component to that, so just bear that in mind. But nonetheless, one of the few vol gainers on the week out here is Chicago wheat. Skew-wise, man, we're all over the place out here. And the skew, that's why I love the ags. They're quite the fun skew tail. Last week, the puts were 6.8% cheap. This week, 5.3% cheap. That's not where the action was, though. The action was on the calls. Last week, the calls were nearly 12% bid. This week, they've been cut in half, 6.3% bid. So whatever impetus there was driving that upside this week, it's still there, but it's been, let's say, mitigated a fair bit out here this week. And I said we're hanging out at about a 637 1/4 in that future. Looking at the 700 calls dominating the tape. 700. That'd be an impressive move. It got 43 days to go, so anything could happen. It's a long time in the ag markets, but still, a 700 club. Let's see what they've got cooking out here. It looks like about 14,000 of these going up this week. Half of that on Monday. 7,200 on Monday. 5,400 on Wednesday, 1,100 today, and about 500 on Tuesday. Opening all week long for a total OI coming into today of 12,600. So it looks like folks are piling in to the 700s. Of course, that skew came in. So maybe, Carley, maybe they're taking some of your advice and overriding those 700. You like that better as an override here, the 700s?
Yeah, I hope so. I think this is kind of like a lot similar to the natural gas phenomenon, where people kind of got used to really, really high prices and they think that's normal, but that's not normal. The last time wheat traded $13, $14 was 2008. And we basically traded in the 5s and 6s for multiple years after that. There was a few temporary rallies, but I think we're getting back into the basically $5 to $7 range in wheat, as opposed to anything higher than that. So I think wheat goes a little higher in the short run, but I'd be a seller of calls rather than a buyer.
Yeah, that skew seems to be backing that up. Worth noting the 650s, the 6.5s also trading this week. That's a little closer to at the money. It looks like folks were bailing on those this week, 9,300 times, including 4,600 on Monday closing, 4,000 on Wednesday also closing, about 500 on Tuesday also closing. So folks bailing on the 650s and opening on the 700s all week. So are they rolling? I guess, I mean, we're getting close to 650. So I guess if now is your time, if you're a little spooked, maybe you roll up to the 700s. That's an interesting one, though. I'm guessing maybe they're rolling an overwrite, getting a little spooked. But buying the 700s, that's an interesting prospect out here, given where we are in the ags landscape. And right behind it, if 700, if that's not optimistic enough for you listeners, let's go to the 800, shall we? 8,500 of those going up this week. The big day for those, Wednesday, 4,000 on Wednesday, 3,500 on Monday, and about 1,000 on Tuesday. A big goose egg today, and an OI coming into today of 5,500. So folks, opening on the 800s, opening on the 700s, and closing on the 650s this week in Chicago wheat. Fascinating stuff. Again, that's why we have to crunch the numbers on the show every week, listeners. All right, speaking of the show, listeners, that music means we've come to the end of another sojourn through the world of futures options. But before we go, Carley, if you want to leave our listeners pondering, maybe there's a product that didn't make it onto the show this week that you think might be worth watching for them, or maybe you have a trade or two that might be intriguing to them, or just maybe a thought you want to leave them with. Now is the time. The floor is yours.
Okay. I feel like things feel a little too bullish in the equity markets. I cannot rule out new all-time highs. In fact, we could very well see 5,400 in the S&P. But as this is happening, assuming it does, you should be thinking about hedging. You can do risk reversals in the S&P, sell calls, buy puts, and hedge your portfolio.
How dare you? How dare you question the permabull, Carley? That's it. You can never come on the network again questioning buying stocks. How un-American of you.
I know.
Well, in the meantime, if folks want to maybe take the other side of that, they want to argue with you, or maybe they want to just put up a few trades, where should they go? What should they do?
You could reach us at DeCarleyTrading.com or on Twitter. The handle is @CarleyGarner.
There you go. Give her a follow on Twitter. She's always tweeting out interesting stuff in between appearances on this show. @Carley Garner is the place to find her. All one word, Garner. All right, and you also know where to go to find all of this data we're talking about. You kick things off, cmegroup.com/TWIFO is the place to go for the TWIFO reports. And if you're intrigued by CVOL, that's available to everybody. Just type CME and CVOL in your browser. That's the easiest way to get it. You can go digging through the CME website, but it's easier. Just type CME and CVOL. You go right to that report, flip to the aggregates, shift the date range for 1 week, and you can see exactly what we were talking about here on the show today. I encourage you to do that. The vol trends are intriguing and certainly worth keeping an eye on. Unfortunately, that's going to do it for us on the network today. Back again tomorrow, noon Central, 1 p.m. Eastern, to talk all things volatility on Volatility View. Should be a fun one. After that, coming back exclusively for our pro folks, options oddities. You want to learn how to join that show and all the other exclusive stuff we have, theoptionsinsider.com/pro is the place to go for all that. Then we're back again next week, another episode of This Week in Futures Options. Stay safe out there, everybody.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.